Hey guys, my name is Olga and we value money here. So congratulations, it looks like you decided to explore new horizons and become an investor. You've probably watched a few videos and maybe even opened an account, and now, overwhelmed with all the information out there, begin freaking out. Well, no need to do that because I'm going to walk you step by step. Yeah, well, there are a lot of aspects to consider, but the very first thing you need to learn is how to do stock analysis. Basically, there are two approaches to do that. It's fundamental and technical. Sounds a bit boring, but it's not that bad, I promise. Besides, knowing how to do that will help you a lot. So the first one, fundamental, is used to estimate the financial standing of the company. If you're looking to become a long-term investor, which I suggest, it's in your best interest to choose so-called blue chips. They're like steady stocks, I would even say risk-free if there was such a thing on the stock market. Spoiler, it's all about risks. You can never predict what's gonna happen on the market. Well, reverting to the subject, in a nutshell, if you're looking for a stable income in dividends, you really need to boost your fundamental analysis skills. Another approach would be great for you if you're willing to trade every day and make your profit in the gap on exchange rates. In this case, you have to know when is the best time to purchase and sell. And for that, you do need to be aware of the technical indicators. Well, your first question must be, how do I start? Well, here are some rules for you. First of all, you need to know about the company you're about to invest in. Do some research, search for competitors, what the company does, what is their financial position. One last thing you need to consider is the opportunity and prospect analysis. These are the key criteria that should be a base for your decision making. There are millions of emittents on the stock market, and each of them has like 200 pages. Please, do me a favor, don't read them. Just choose a few most interesting options that will suit best for you based on 3 or 4 criteria. Well, now it's time we talk about something we use on daily basis. What do we do when we go to supermarket, passing by the shelves, choosing the next book to read, or the next iPhone in the Apple Store? We do benchmarking study, or just simply compare things to find advantages and disadvantages. It is no wonder that we can also use this approach in the stock market. It is claimed that market is usually right about the price, but sometimes it can be mistaken about the value of some papers. This is where the benchmarking study comes to help. As time and some possesses goes by, price becomes fair. Without a doubt, there are services that help you to look for the stocks and buy them based on the established parameters. For example, Screener, Google Finance Screener, etc. But the question is, what numbers are important here? Well, the stock market is all about indexes and multiplications, and we will definitely talk about them in my next videos. For now, let's just stop at the most important ones. First of all, you really need to know what enterprise value or EV is. So basically, it's the total company value, and it includes company's capitalization, short-term or long-term debt, and also any cash that is on company's balance sheet. This indicator is used to evaluate business performance. So it's basically telling you if the company is worth investing in. When we are talking about stock market analysis, EV is used to evaluate multiples. It's a difficult part, and I'll definitely shoot a video about it. Now that you know a little bit about fundamental analysis, let's talk about money management. And there are no prizes for guessing that it's all about managing your money. It is also a key to success in investment. Even if you have the best strategy ever, you could face losses just because of violating some rules it dictates. You can't avoid making mistakes or losses or making bad decisions, but loss of a capital is too high price to pay. You begin getting a stable income just when you stop losing your money in the long term. So maybe in the beginning just stick to lower risk strategies. The most common mistake the newbie hears is like, buy this stock, it's 100% win-win. And I've been there. In the long term, it never results in anything good. The only rule that works in 100% cases is nothing works in 100% cases. And this is the main rule on the stock market. What money management does, it tells you how much you can risk and what part of your budget is not to be touched, even if you really want to. The first thing you need to do is to decide how much you are ready to risk when investing in certain companies. Personally, I've come to 5-6% of the deposit per each paper. This strategy really diversifies my risks. I buy stocks every month, so my portfolio is balanced and it's safe from severe losses. Besides, it has growth potential. So it's all about this fine line between being too risky and too safe. The last topic to cover is how to use money management for your personal finance. I'm not gonna give you like strict rules to follow, it's just more of an advice. First of all, set aside just about 10% of your income and don't touch this money under no circumstances until you find a great and successful investment. Keep the household budget to realize what your financial state is. Besides, it's going to help you to know what your weaknesses are. Like, maybe you are buying too many margaritas on Fridays. Think about indispensable purchases in the nearest future. Try and save up. Remember, what do you need more? An extra margarita now or extra $100 of dividends in a few years? Well, that's all for today. Don't forget to subscribe and smash that like button. I will also really appreciate if you share this video with your friends. I'll be back really soon. Stay tuned.